I think now's great.
Sorry, did you? Okay, awesome. Well, good afternoon, everyone. My name is Harry Singh, and I'm the chair of programming for the CFA Society Winnipeg. Uh, I'm thankful to everyone who has decided to join us today with the BlackRock event. Before we begin, I just want to start with the land acknowledgement that we are here gathered today on the Treaty 1 territory, the traditional land of Anishinaabe, Cree, Oji-Cree, Dakota, and Dene nations, and the homeland of the Red River Métis. We also acknowledge that the water we drink and use comes from the Shoal Lake 40 First Nation. CFA Society Winnipeg has served the Winnipeg investment community for more than 70 years by promoting ethical and professional standards within the investment industry. The society is an active participant and innovator with the CFA Societies Canada, which is why we have collaborated with CFA Society Saskatchewan and Edmonton, and is one of the CFA Institute's global networks of local societies. Today we have Glenn Purves from BlackRock and Caitlin Ebanks moderating this event, with Glenn Purves providing his insights. So without taking much time, I'll hand over it to Caitlin. Caitlin, thank you.
Thank you, Harry, and good afternoon, everybody. Welcome to today's webinar. Today, we're going to be talking about BlackRock's macro outlook for 2025, AI, tariffs, and some volatility ahead. We are delighted to host this webinar in collaboration with the CFA Societies of Winnipeg, Saskatchewan, and Edmonton. We appreciate your time. Before we begin, I do have a few housekeeping items for you. You've all entered today's session on mute and will remain on mute for the entirety of the session. Please feel free to drop your questions into the Q&A, and we will answer as many as we can at the end. We have left some time for your questions and to hear from you. My name is Caitlin Ebanks. I'm a VP on the Americas Institutional team at BlackRock, and today I'm joined by Glenn Purves. Glenn is the Global Head of Macro at BlackRock Investment Institute. He leads our macroeconomic research. He engages with our investment leaders to drive decision-making and deliver insights to our clients. Glenn brings a wealth of experience to our discussion today, with a distinguished career spanning across various senior roles with the Department of Finance Canada and the IMF. And he is a Canadian. So welcome, Glenn.
Hi, Caitlin. Great to be here.
We're happy to have you. So I thought we would start today out with a couple rapid fire questions for us to get to know you and
Sure.
also get to know how well you know Canada. Um, so I know you spent a lot of years living in Ottawa. Ottawa is known for the Byward Market, beaver tails, skating on the canal, and obviously a great place to be on Canada Day. Having lived there though for 20 years, what is your favorite thing to do in the nation's capital?
Oh, well, I think that's a great question. By far, so I'm a Toronto native, moved to Ottawa, raised the family in Ottawa. And you're right. I had a lot of time at Finance Canada, Treasury Board, and so forth when I was in Canada. And I loved getting on the canal and skating the work. So I think that was numero uno in my book.
Perfect. I'm sure you showed up so bundled.
Always,
Um,
always.
so I do have to ask, where is your favorite place to vacation in Canada? Especially with a weak dollar, I think a lot of us are probably thinking about staying home for family trips this year.
Well, we've got a cottage in Ontario, so on the lake. There's nothing better in the summer from my standpoint. Out west is amazing as well. Like there's just so many places to go. My spouse, her family's from Bucktouche, New Brunswick, and I would say out there would be a very close second.
Perfect. I agree. There's so many great places to go. So, are you a skier?
I am. I am. My son is an instructor at a hill, so every weekend he's out there instructing.
Well, I have to ask for the Albertans on the line, Sunshine or Lake Louise?
Sunshine. Sunshine's always been very close to my heart. I love sunshine ever since I was a kid. Going out and hitting the bowls out there has been amazing. And I did that actually a year ago. So we still do it.
Right answer. Right answer. I need to move to a very Western Canada focused question around your favorite CFL team.
Yeah. Well, I got to say, the Red Blacks, of course, because they're in Ottawa, but I love the Blue Bombers as well. I've loved the surge that they've had over the last few years. I've always been a Blue Bomber fan.
Okay, I'm sure there's many of those on this call as well. And final question, I'd be remiss without asking favorite hockey team.
Oh my God. Well, this you may see the participants numbers start to drop when I say this, but I started out saying I'm a Toronto native and I'm a Leaf fan, and for good or bad, I'm a Leaf fan.
Well, follow up. The Oilers played in the Stanley Cup Finals last year. Winnipeg, the Jets are number one in the league right now. How do you like the Leafs' chances at the Cup this year?
I don't know. Like the Oilers are very close second, as you can see by the color of my hair. I grew up during the Gretzky, Messier, Coffee, Anderson, like Fuhrer, like that whole sort of scene. It was near and dear to my heart. So, but those two teams are amazing. And as it goes, like anytime you get a team going into the playoffs, whichever is the last Canadian team I usually cheer for. So
Yeah, definitely. Well, let's switch gears here and let's start by talking about some mega trends. So, first, what is a mega trend? And then, second, why are
yeah,
mega trends and AI in particular? We're hearing a lot about AI right now, such an important technological advancement in your view?
yeah. This is BlackRock has been, I would say, at the forefront of thinking about supply disruptions. So the best way to think of it is for years in economics, you always thought supply would be able to meet any fluctuations in demand, right? And actually, there's a term for it called divine coincidence. And in a way, it's a reason why interest rates were able to be so low in the past is that, in fact, you had supply being able to meet whatever swings in demand materialized. And those swings in demand are what really drove the business cycles. And so a few years ago, actually more than a few, I think BlackRock was one of those that really, and this is before I came on the scene as well. We're really on the forefront of thinking through how is it that we see disruptions in supply emerging, and what does this mean for the traditional business cycle? So disruptions in supply can be things that are things like demographic shifts, geopolitical fragmentation and economic competition, the breaking up of blocks and so forth, realigning supply chains that we saw even before COVID, and things like the transition to a low carbon economy, where in fact, depending on where you are, how you get energy, how you get some of the commodities that you need in order to as inputs to your outputs uh, become more disrupted and so forth as you try to strive for net zero. So those are a few examples on I would say, not the headwinds, but the more structural sort of elements. And then some of the more novel ones that we've seen lately are in, as you cited, the AI. So what is it that we can expect on AI in terms of enhancing productivity? What's required of AI in terms of energy needs and so forth? And then the last one is the future of finance. So how do we see fintech sort of emerging, Bitcoin, the future of Bitcoin, all these cryptocurrencies, how that all plays in. These are what we call mega trends, these five things that I laid out. And we see these things as disrupting the business cycle. So you're not really in a business cycle environment anymore. You're in an environment that's shaped by these mega trends. And as a consequence, you're seeing some economies divergence in how some economies are performing.
I think that's really interesting to think about it from a disruptive lens. So let's pick up on that kind of supply chain disruption, rates, growth. BlackRock was one of the first to recognize this impact of supply side factors. How do we anticipate these playing out further into 2025?
Yeah, so I think the best way to think of it is we always knew that there would be these disruptions, and we see that playing out in terms of inflation. So I'll speak for a moment about the US, right? If you look at the volatility, the inflation volatility that we've seen in the US, we saw some stickiness coming in terms of the service level inflation. Goods has sort of come down to zero. Um, and you see the inflation expectations going out. I think, over up to maybe a couple months ago, I think there was an expectation that you'd be seeing a couple more cuts by the Fed in 2025. And so we always knew that these mega trends would have this impact on the stickiness of inflation. Now overlay on top of it a lot of the recent news coming out in terms of the priorities of the new administration in the US. So tariffs, for instance, some of the uncertainties on how tariffs are going to be playing out, whether it's as a tool in order to seek negotiating terms on a host of issues. We saw that the administration is looking at reciprocal tariffs, which is very different than across the board. This is each country will have a customized agreement tariff arrangement with, and it's not just related to one sector. It's related to foreign currency movements and actions that they take to intervene in foreign currency. There's the structure of the value-added tax and whether that actually penalizes American exports. And that's a very different attribution than just the traditional levy of an across-the-board tax, either across the board or in a sector in particular, right? And these typically tariffs are a tax, right? And these are things that can lead to inflation both in the country that is applying the tariff, but also in the country on the receiving end of the tariff. And so when you overlay these aspects on top of these mega trends, and I'd say it amplifies the one that we call the geopolitical fragmentation mega trend, then this in fact brings into light a higher, what we would see as a higher rate environment going forward in the US. And then, of course, every country has got their respective issues that they're dealing with, in the UK and in Europe, in Canada, for instance, right? Like where interest rates are at a very different place and inflation's at a very different place. But a cascading set of impacts on the macro side that will really have an entrenched impact on each.
Do you think that this is going to lead to like a broader, a broader economic fallout, maybe globally, perhaps in the US? This idea of tariffs maybe causing a higher rate environment for longer, reassessment of supply chains, corporate and investor confidence maybe being a little bit skewed or strained trade alliances. What are your thoughts here?
Well, what I've seen is a variety of a variety of impacts that a number of different houses have put out. And it just goes to, I would say, some of the uncertainty of the environment, but questioning the ultimate plan as well. And the combination of the two mean that I think in this context, you really have to break down what the potential impact is in order to be able to have a sense of the macro story, right? So let's take tariffs, right? if all of a sudden reciprocal tariffs were applied across the board and all VAT was captured in as well, right? That would have an effective tariff rate much higher. I would say between 15 and 20%, as opposed to something that we'll eventually see. Because I think as a negotiating tool, the eventual tariff, the actual direct tariff, the impact of that direct tariff will probably be less than that, and it will be somewhere between 0 and 10%. And even the Treasury Secretary, when he was asked the other day, well, how much fiscally will tariffs bring in? He used 10% as a proxy for making that valuation. And he said 2.5 trillion over the next 10 years, which is consistent with 250 billion per year that they would see it bringing in. And I think the question though is there's the direct impact, but then there's the secondary or indirect impact.
Mm-hmm.
And that's the real interesting element, right? Because it takes into account a few behavioral aspects. The first is, are we seeing a lot of inventory stockpiling going on right now? Are companies trying to get out ahead of tariffs by importing as much as they can in order to keep their inventories whole for an elongated period of time? So what's the behavioral impacts of anticipated tariffs, right? The second is, what are the investment and production decisions that companies are thinking about in light of the uncertainty of the environment, right? Are they putting on hold some investment decisions? Are they deciding to put off increases in production that they thought would be in play? And how do those trickle through in terms of the supply and in terms of meeting the demand? And then it kind of dovetails back to the point I said at the beginning, which is, supply disruptions in meeting demand and just amplifying that. And then the last one is, and I think you've seen it in commentary, I know in Canada for sure. You're seeing it here in commentary around the houses in New York and so forth, about rewiring of supply chains. So what are some of the rewirings of supply chains that are more permanent beyond maybe some of the temporary halting of investment and production decisions? And in fact, the governor of the Bank of Canada, Tiff Macklem, actually gave a speech in Mississauga on the 21st, which touched on a lot of these issues as well, and in particular for Canada.
Well, let's dig a little bit deeper here on trade alliances, in particular, Canada and the U.S. Against this backdrop of these new, like now delayed U.S. tariffs, hopefully they don't don't proceed. But there are tariffs on China. Can you set the stage on like what this means from a global markets perspective, both short and long term?
Sure. I think in the short term, it depends. With tariffs, it depends on the permanency of these things. And in the short term, you may end up getting more inflation. I think you would, in receiving as well as applying countries. And I think that, as a tax, tariffs as a tax, they increase the input costs of goods, and that trickles through in terms of the inflation numbers, right? The extent to which it trickles through and so forth always depends on the foreign exchange pass-through, right? There's the foreign exchange, does the US dollar completely adjust for the same amount of the tariff that's applied, including the retaliatory, or is it partially adjust? And you're going to have consequential impacts on inflation, but also on revenues that they're bringing in, as well as the ability to address address some of the trade deficit aspects that had been identified. I'm not speaking specifically about Canada, but other jurisdictions in particular, because Canada, it's a trade deficit for Canada if you take out the energy element, right?
Mm-hmm.
Um, and then beyond that, the permanency, then it becomes a question of rewiring and changes in supply chain alignments, and that's where it actually gets very interesting. Do you have a situation where economic policy, which is intended to onshore back into the United States and to increase manufacturing and the purchasing of domestic content, does that have a cascading impact on how other countries deal with their own competitiveness issues, right? And the one thing I'll just mention is, when you look at Europe, for instance, we had the German election yesterday, and you heard what Merz was saying about looking at continental Europe and an economic plan for continental Europe. And in Canada, for instance, you look at a lot of discussions about dealing with structural impediments to trade, interprovincial trade barriers we've seen, but also issues on productivity that have long sort of plagued the country, right? It may be that these are the things that lead countries to take the actions needed in order to improve the fluidity of their own economies, right? And I'm not justifying tariffs, whatever, at all, but I am saying that when you think about the external impacts of tariffs, there are the direct and the indirect aspects that could be more costly and that could be inflationary and could impact growth. But there are also those elements that are structural impediments that could force countries to address these head on. And you look at Germany, for instance, you look at public investment, private investment, you look at the imposition of the debt brake, their deficit GDP ratio hasn't been able to exceed 0.35%. You look at the need for Europe to harmonize better their banking regs and their capital market regs. You look at the labor market structures of Germany needing to expand labor supply and the productivity of that labor supply, and potentially improving skills and technical training in order to do that. And Germany really is an important economy for the broader Europe, and their debt to GDP ratio is 65%. So it's very interesting to see whether there's cascading sets of actions that could come out of these issues. And ideally, in an ideal world, you would see domestic demand pick up in China, and you would see it pick up as well in Europe and Germany in particular, as a consequence of some of these reforms that you may need in order to address and to respond to the economic challenges of tariffs, right?
Well, and I think when we think about Canada as well, we're a very resource-rich country. So, from that perspective, hopefully, maybe tariffs, offer greater productivity in Canada, or force us to structurally make that change or shift. But also, perhaps diversify our economy a little bit as well. Maybe bring back a bit of manufacturing. What are your thoughts there? Would that help in the success if these tariffs do go on long term?
Well, I do think that interprovincial trade barriers are very important to address in Canada. Those and productivity, if there is a path to, Tariffs are inflationary, and they will have an impact on growth, and the extent to which this is permanent in terms of lost consumption and lost output will depend on the permanency of these and what kind of hard wiring there is. And and I think for a country like Canada, thinking through the impediments for domestic trade is absolutely critical. And it's been on the horizon, and it's been discussed at many fora and many, you know, provincial meetings and with the federal government as well. And there's been many efforts to try to launch efforts on that front. But I think from an economic security standpoint, it's a critical issue, and there's an opportunity to really pursue that, including addressing total factor productivity and dealing with productivity issues that have continued to lag behind the U.S. And that is something that good active Canadian policy will need to take into account.
So maybe before going out and finding other global trading partners, we should consider trading amongst ourselves first.
Well, I think it's useful for any economic plan not to do things sequentially, but concurrently. And I
Sure.
think, you know, um, look, there's no question that, tariffs present a monumental challenge to Canada, depending on how they play out. Like right now, we're looking at 25% steel and aluminum in
Hmm.
Canada, and China is looking at 10% across the board, right? And that 25% is applied to all imports of steel and aluminum. And depending on how it plays out and what is actually implemented versus what is used for negotiating purposes, uh, it'll be important for any country, not just Canada, but any country, to be thinking about the competitiveness of their own economy and how they can make improvements to that competitiveness. Part of that could be through trade alliances, but also new alliances, depending on how the needs of countries and where the opportunities present themselves. And I think, certainly there's a trade agreement with Europe, and it'll be important for countries to be able to diversify and take advantage of those domestic, impediments, but also to take advantage of the opportunities that present themselves externally.
Perfect. Well, thank you. So before we open it up to the audience, which as a reminder, if you do have any questions, there is a Q&A box. You can feel free to pop those in. We've had a couple come in so far. But can you share any guidance you might have for the CFA Society members, but also like the broader financial community, just investors in general, on navigating the economic uncertainties of 2025?
Yeah, I would say a couple things. I was like, there's been a lot of commentaries out there about the impacts of tariffs, right? And there's been a lot of commentaries about the impacts of the administration, but it's going to be important to think about it in a frame, right? I was impressed with what the Bank of Canada governor put out in terms of the frame that they're looking uh, at his speech in Mississauga. Like, he's basically trying to say, look, if there's permanency to these, then it's going to have these cascading impacts. And trying to put some element of impact to what that would be for consumption, for output, and CPI, right? But right now, I wouldn't just read stuff and then assume that that's the answer, because there are a lot of there's been a lot of announcements that have been made so far. And the one thing I would just say is reciprocal tariffs, the application of those and how they and what ends up being that effective tariff rate at the end of the day, from a planning standpoint, if we were looking at something, we could use 10% as the potential landing spot for that. But that landing spot might be a long way out, right?
Right.
And it could be wildly off, depending on ultimately the decisions of the administration and the priorities that they see. And there's a big difference between anticipation of tariffs and the actual application of tariffs. The economic and the inflationary consequence of tariff policy begins in the anticipation phase. It doesn't begin when it's actually levied. And I think that that kind of the data on that will have to come through, and people should be thinking about it in terms of the frame of what it means for deficit to GDP, debt
Right.
to GDP, and then broadly speaking, components of inflation, and ultimately movements that are anticipated in the bank rate. And that's why we've seen some repricing of the number of cuts of different central banks quite frequently. And, the Fed, for instance, I think they were pricing in 50 basis point cuts this year. Now,
Mm-hmm.
when I look at it, they're pricing in a 25 basis point cut in September. But part of it in the US, and I'll just end it here, not for Canada, but for the US, like Canada, when you look at Canada, you got inflation at target, you got interest rates at 3%, and you got household spending that's picked up, right? Then you got to consider the impact of tariffs, and that's something that the bank will look at. But for the Fed, it's a different story. You've got inflation that's much higher, and it's sticky, and you've got rates that are much higher. And the Fed, of course, uh,
Oh, we're losing your audio a little, Glenn.
yeah, the current stance of the Fed is very much about um, being chasing price stability. And so long as that exists, then they're going to have to be watching the inflation very carefully.
Well, one of the questions that just came in from the audience is the Canadian dollar has fallen about 4 cents against the US dollar since last October, when a Trump presidency became a lot more likely in the polls. Do you think that these tariffs are fully reflected in the exchange rate?
Yeah, I don't. That is a great question, and I think it's one that there's no perfection when it comes to exchange rate movements, and whether there's going to be perfect adjustment or not. Like it's a great question, and it is when you think about what the impact of tariffs will have on inflation, on growth, on the impact of dealing with the trade deficit, but also in terms of the fiscal revenues that you bring in on that.
Hmm.
A lot of that is determined by how much is passed through and are adjusted into the FX. And what I mean by that is if there's a 10% tariff that's applied, that the dollar, the currency of the applying tariff, like in the US dollar, for instance,
Hmm.
adjusts upward 10% in order to address some of the pass through. That is something that I think theoretically might exist, but I would be very shocked if there's been a full adjustment already in the FX. But it is a question that is very much addressed with perfect hindsight, as opposed to forecasting. I've seen people forecasting on currency movements, and it's been and they've got it wildly wrong. So that's one that I'm very hesitant to opine on, definitively. But
Well,
it's understandably it's an important question.
and I think like the second part of their question is like quite optimistic that if these tariffs are, are maybe not as robust or don't last as long as or aren't permanent, um, would we expect a rebound in the Canadian dollar? And it sounds like
The
unsure.
US the one thing I will say, like whether people strengthening of the US dollar will be a lot of it is dependent on your inflation expectation. Like if you think the Fed is going to have to raise rates or will hold cutting rates, that is something that strengthens a US dollar, right? So it comes back to inflation expectations. And there's a very tight correlation between the movement of the US dollar and inflation expectations, right?
Perfect. Okay, so we've got quite a few questions coming in here. What do you think about India and the US relationship because of tariffs?
The relationship with India and the US, well, India,
Hmm.
of course, has, when you look at it through a reciprocal lens, India has very high tariffs on US imports, US exports going into India. And so I know there's been a lot of pieces that have come out in the last couple of weeks when reciprocal was announced that has identified India as one of the countries that would stand to have the greatest level of boost of tariff applied to it in terms of its imports. Um, I think I do think that we haven't seen we haven't what the administration wants to do is study this, and they're giving themselves to April to study it, and then they're going to go out one by one and uh, and look to negotiate these tariff arrangements. And right now, it's uncertain specifically what the administration will be looking for with India. Having said that, it's a very important trade relationship that they have. Um, they have a strong service sector relationship as well as goods. And that is something that will have to be watched very carefully. But to know with precision how that's going to play out is, I'm watching as well.
So, another one of the questions from the audience kind of circles back to where we started around disruption, volatility. Any
Mm.
recommendations for possible hedges to assets in this new market? Like, what are our kind of views on over and underweights?
Well, I would say like um, I would I would describe it as a bit of a tug of war between rates and growth in the U.S. And so when we put out a weekly commentary, and anyone can go onto our website and they can look at our weekly commentary. And the one for this week was really focused on broadening out our pro risk view. So I would encourage you to read those because at the back of them they have what is our calls, like our tactical calls in terms of the BlackRock Investment Institute. And right now we're still from an equity standpoint, we're still pro risk US equities. They've underperformed European equities since the beginning of January. There's no question about it. But we do think that um, that U.S. equities writ large, and in particular those in tech, have a lot of momentum to them, and that there's a lot of more growth to go there. We do think that, for instance, on the long U.S. Treasury side, that term premia, when you look at term premia, you're at about 50 basis points on the 10-year, right? And the question is the risk to the upside or the risk to the downside there? And
Hmm.
I would say that the risk is more to the upside there. So we would be more underweight when it comes to long US Treasuries. On European equities, which have traditionally underperformed against the US equities as an asset class, at least in the last couple of years, we're actually seeing, we're seeing some revaluation going on there. Now, it could be for a whole host of different reasons. We still think that US equities at the end of the day will outperform, but it could also be an anticipation that there will be structural changes in Europe as a consequence of these actions, and that some of that discounted valuation may actually be repriced. And so, as a consequence, there has been a move up. We're not putting it as an overweight to the level that we're putting US equities, but we've moved it back to a neutral stance on that front. So I would encourage you, if you're interested in our granular views on asset positions, we got this great product every week coming out. It's called Global Weekly Commentary, and at the back of it, it provides all those details, and we give a sense of if we're moving it one week to the next.
No, that's perfect. Thank you. And thank you for highlighting the resource available as well. What are some of the key indicators or metrics that investors should be watching closely to navigate these uncertainties through 2025?
Well, I think we've always kept an eye. It depends on the market, right? If we're talking about the US, certainly inflation movements are going to be important. And we're going to have to think I think that the outcome on inflation is something we've always thought that it was stickier than most. And I think of course, this tariffs coming in and the uncertainty about tariffs just amplifies that position. But to the extent that it leads to a halt of cuts by the Fed or increasing the rate again will depend on some of the data that comes out over the next few months. And so I think, it's a lagging indicator, that's for sure. It's not going to pick up full inflation or as full tariff policy aspects, but it'll pick up the underlying foundation for the US economy. And that's something that we'll be watching very carefully, I think, going forward. The next is on the growth side, how we see potential delays in investment and production decisions factoring into growth outlooks. Decisions at the micro level, decisions of companies to either halt expansions or to relocate to different countries, depending on the sort of the consequences of various actions. So that's the US. In terms of Europe, watching very carefully the formation of this coalition in Germany, the extent to which Europe is looking to create a central approach to defense through EU financing, structural changes over there that are maybe on the horizon that could help to improve the competitiveness and deregulation and so forth. And then on we could talk about the UK as well. Like that's a fascinating market right now in the UK. Like they've got a majority government in a Westminster system. That's a very influential. They could take policy anywhere they want, right? They don't have some of the impediments that other jurisdictions have. Having said that, you've seen them signal that they're going to be going through a spending review, and the tax hikes that they put in place brings revenues to GDP up to about 40%. And a lot of that increase is going towards paying down additional debt service costs. And so that's a fascinating market to watch in terms of revenue receipts coming in, and whether in fact the level of borrowing that they need to do has to increase up and beyond what they're seeing right now. So the point is that every market has its own unique factors to watch. And I think that's indicative of the fact that we are out of this traditional business cycle, and all economies are looking to adjust in this new reality of supply shocks. And we had this one that was in place. We had COVID. We already had these, 5 mega trends that we set out. And the one that is being most amplified now is the geopolitical fragmentation and economic competition. And I think that's going to play out very heavily over the course of 2025.
Definitely. And would you say then, as an asset allocator, it's important to be nimble through 2025?
I think so. Like whether you care about the markets or whether you care about the macro, devil's in the detail, signal to noise. I know it's cliche to say signal to noise. Always have a frame that you're putting the data into. Keep in mind that this is an environment where you can't just run the conclusions, and being nimble on an asset allocation standpoint is going to be very important.
Perfect. Let's switch gears. There were a couple questions that came in around AI. So one pretty specific in terms of sector, so would love to hear your thoughts. But what is the impact of AI on the finance industry going to be?
Well, look, I think that AI has a potential to disrupt in a good way a lot of industries. On the finance side, depending on how systemic, asset allocation, equity allocation evolves, I think there's definitely an application for AI there. There's certainly an application for AI on the productivity side, writ large. And how this all plays out will depend on, I think, companies' ability to be able to integrate that into their work. And one of the challenges on the financial side is sometimes you have proprietary information, and moving into an AI world requires you taking a leap and sharing proprietary information. And you've got privacy rules, you've got a whole host of different operating parameters that are intended to use the benefit of AI, but protect effectively on the financial side. So how that plays out will very much be guided, I think, by the individual firm's operating principles and risk tolerance on operating risk. But the applications and the ability to integrate it will grow and grow. There's no question about that. And I think that I would say the first wave of efficiencies that can come from it really are on the productivity side. I think every organization has to provide advice and write memos and write notes, and there's always a lot of time that is taken providing a base of information on some of that. And if you can save time by using AI and your over the course of your work, then that's going to be very very critical. Beyond that, as we move up the spectrum and get to AGI and more like medical applications for AI and so forth, that's going to be very fascinating. And and it's that aspect that we're looking into, and we put out a paper on AI where in November, and so you can go to that as well, where we've staged out the different steps on AI build out and AI application and adoption,
Hmm.
and trying to give a sense of where we think we are on that and where we think the trends are going. And a lot of that will depend on the availability of ample amounts of energy, but also the advances that are made in order to reduce the amount of energy that is expended per query. And that
Well,
finding that equilibrium is going to be really important, right?
and I think a lot of times when you hear about or read about AI and increasing productivity, there's a bit of a fear that it's going to be at the expense of people's employment. So, any thoughts on if AI is going to kind of cause maybe a spike in unemployment rates?
Well, the IMF actually put out a good piece last year on the importance of having nimble labor market policies in order to be able to integrate AI in. And part of that, if memory serves me, was about the potential for more job sharing, the potential for more flexible work arrangements that would allow companies to benefit from AI, but not lose talent at the same
Hmm.
time. And shifting people from doing things that AI can now do to upskilling and to higher value applications and higher value skills. That is something that I think will come over the next 3 or 4 years. Um, and I think the value proposition of AI, which is, it's already factored into a lot of the valuations of these companies, will really start to show themselves in their application on that front. Um, with these disruptive technologies, there's always certain breakthroughs that come around, and I think personally, I'm very interested just in at what point there's going to be this shift where in fact AI is just far more mainstream than it is now.
I think it's coming. I know
I
I
think
use
so too, and it,
Copilot. Yeah.
I think so too, and the question's going to be uh, just when that point materializes. Like I think we're already seeing it now, but just um, and it depends on the industry that you're in, right?
Hmm.
Um,
No, I think it's fascinating and it's going to be very interesting to watch. So today we did talk a lot about the geopolitical risks of tariffs. One question that came through, which surprised me because I haven't seen it in a while, is what is the impact of Russia and Ukraine currently on global markets, especially with Trump and Trump policies, um, perhaps no longer funding Ukraine as well.
well, I think there's the fiscal aspect to it, but then there's you know I think there's when you look at a lot of the commentary out there right now, whether there's going to be a peace dividend, whether there's going to be some sort of stabilization in the markets where somehow you're going to have less volatility and asset prices will continue to move up. We have not actually lived through a period where we've had this kind of crisis to be able to sort of say, okay, it's going to be just like 10 years ago when we had X. Like you don't just have Russia and Ukraine, you've got issues in the Middle East,
Hmm.
the war in the Middle East, you've got a whole host of different factors that play in. And whether one level of geopolitical defragmentation or fragmentation is appearing to resolve itself and leads to some sort of net improvement from a market standpoint, maybe there is, but then you've got a whole host of other geopolitical fragmentation issues that are playing out
Hmm.
that would have to play out and would have to be netted against that. So it's almost impossible to say, this would be the impact. Having said, for two reasons. One is we haven't actually seen the experience of that to be able to map against it. And the second is um, there still are a lot of other factors out there that are contributing to that mega force, and that we continue to see sort of persisting. And the third is you never know what can play out, what the result would be in terms of some sort of settlement, and what the ramifications are on a post basis. You could have an arrangement that leads to greater stability, or you could have a different kind of arrangement. All to say, though, it is one of the elements that is, again, contributing to this mega force, and it's something that is to watch out for as well.
No, appreciate that, Glenn, and appreciate all of your insights today. Any final thoughts in the last couple minutes?
No, I think, look, for those that are younger, there hasn't the level of uncertainty and the level of movement of policy, proclamations, and decisions of responses, reactions. Um, this last 2 months has been, I would say, um, the most unpredictable on that front. And so it's important to take that into account. Um, it's important not to draw conclusions quick, and it may be that you have a certain level of volatility that comes from that. But it's also not, I don't think someone can run off and say, well, this is going to contribute to a bear market, because um, it's not, there's a lot of inconclusives on that front. What it means is that there's volatility, and in volatility, there's always opportunity. And so it's going to be important to see the trends in that volatility and to be nimble with respect to your asset class management and your portfolios.
No, that's amazing and a great place for us to end. So, Glenn, thank you so much for your time. We truly appreciate it and your insight. I'm going to pass it over to Harry to close us out.
We're gonna give it to David.
Sorry, David.
No worries. Thanks, Caitlin, and everyone. My name's David. I'm pleased to be representing the CFA Society of Edmonton today. As we close out our Outlook event on behalf of the CFA Societies of Edmonton, Saskatchewan, and Winnipeg, thank you again, Caitlin and Glenn, for moderating today's event and sharing your great insights. And a big thank you to the BlackRock team for being an organizing part of the event. And finally, thank you everyone on the call for your time today and for your great questions. A reminder that this event was recorded, and a link of the recording will be sent to all participants, along with a link to BlackRock's Market Outlook. And that concludes our 2025 Market Outlook. Thank you, everyone.